Okay, so these tariff pressures are showing up a bit now on Asian screens. The Hang Seng's down about 0.5%. Mainland Chinese markets are also not feeling that great, 0.4% lower thereabouts. Singapore is also lower. Japan's absolutely flat. So let's see, let's get the implied open up on the screen. The question is whether we have kind of already digested a little bit of this with our big fall yesterday or not. Right now, the implied open is suggesting that we'll maybe start positive. Now, what about individual stocks? As always, we have our team standing by with the CNBC-TV18 list of top stocks to watch. Guys, morning to all of you. Nigel, first up, let's talk about Hindalco. So much news flow around the company.
Well, that's right. Hindalco's numbers were weak. That is, Novelis's numbers were weak. But this is not something the street didn't know. We had a preliminary sheet that came out close to around a month or so ago. And those numbers, in fact, had indicated that these numbers are going to be soft. On an absolute basis, the adjusted EBITDA number was around $370 million. On a per unit basis or a per ton basis, it was roughly around $406 per ton. The reason that these numbers were disappointing, one is because scrap prices went up, which compressed their spreads, and also the sales mix was a little bit adverse. So that's the reason why these numbers were disappointing. The net debt number as well moved up, but we know that they're incurring a big capex out there. So these numbers were disappointing. The point is that the street was aware that these numbers are going to be weak. And there are three reasons why I expect the stock to recover from the day's low. In fact, see a good recovery intraday at some point of time. One is the stock is already down 23% from the recent peak, from the time when they withdrew their Novelis guidance. The second factor is they're saying that Q4 numbers will be as good as Q2 numbers, which means from around $406 per ton, the EBITDA number goes back closer to around $500 per ton. And the third factor is they're saying that the impact of Trump's tariffs will either be neutral to positive, because they've got exemptions in the past in sourcing raw material from Canada as well as Mexico, and they expect similar trend to play out. So it starts in the red. It's a weak set of numbers, but I'm expecting a recovery on Hindalco.
Okay, interesting. For Novelis, it should be actually good, right? They're ultimately they're a US entity, so all this protectionism maybe
but they're sourcing some part of their raw material from Mexico as well as Canada. In 2018, they got an exemption on that front. So they're optimistic they'll get that exemption. Even if not, they're saying that they'll get the benefit of Midwest premiums, which in fact would be positive for them. So, and as the stock was down yesterday, so that's why I'm saying that I'll see a recovery in trade today.
Okay, so maybe a recovery on Hindalco could be in the cards. Let's move on, talk about some more earnings. Vinny, good morning. How does Apollo Hospitals look?
Good morning, Survi. So Apollo Hospitals, a decent set of numbers, revenue in line. We're seeing a beat coming in on the profit front. They've maintained that steady growth momentum that I've seen in the last few quarters. As of now, this time, the revenue growth was around 14% that we saw coming in. Steady growth is what they're sustaining. EBITDA margins, they've continued to see an improvement, 110 basis point improvement on a year-on-year basis. Hospital business, that's seen a very good growth, 13%. Occupancies have improved over there. YOY, 68% is the occupancy in Q3 FY25. ARPOB also seeing a very good improvement. Now the ARPOBs are above the 60,000 levels. Is that going to be sustaining is obviously something that we'll watch out for. When you talk about the Apollo Healthco business of the company, they have sustained managing that EBITDA positive for the last 5 quarters. They've sustained that. Let's watch out for that. It's a positive coming in this time as well. And lastly, Apollo Health and Lifestyle side of the business, that's seen a 15% growth. They've seen a reduction coming in terms of losses YOY. So that's surely an improvement, sustained growth. So we're expecting green coming in for Apollo Hospitals today.
Well, in fact, we have the management of Apollo Hospitals later today at around 9:40 a.m. So we'll understand more about these numbers and the way ahead from Ms. Sunita Reddy. Moving to the auto space then, Sudarshan joins us to tell us about Eicher Motors. How are the numbers, sir?
Good morning, Nigel. So if you remember, after Q2 earnings, company had talked about its preference to growth over margin, and that theme seems to be playing out after Q2 earnings. On that commentary, stock had moved almost 10% higher. And also, if you look at the volume numbers for Q3, volumes were up 19% both sequentially and year-on-year. But the question is, fall in the margin, because Q3 margin has come at a 7-quarter low. So what would be the margin levels that company would be comfortable with? For Q2 numbers, revenue has increased 19%, EBITDA was 10% higher, and margin has fallen almost 200 basis points. It has come at 24.2%. versus 26.1% against same quarter last year. Talking about the margin that was impacted because of certain reasons, company says because of product mix. Recently, company had launched Bullet Battalion, which is at the lower range, and that seems to be impacting the margin, and that seems to have helped volumes on monthly basis for the last few months. Company continues to report volumes more than 90,000 units. Also, company has not taken price hikes over last few months, and these are certain reasons that seems to have impacted margin. And on the basis of Q3 numbers and miss in margin, I'm going with red for Eicher Motors.
Okay, all right, Sudarshan, thanks a lot for that. Well, I'm looking at Grasim, and remember for Grasim, you look at the standalone numbers because you already have Ultratech and the other subsidiaries that it has in the price. Now, these numbers look disappointing. The margins came in at around 3.3%, and they delivered a net loss because the finance cost as well did balloon up. The problem is on the fiber business, because out there the profitability came down both on a year-on-year basis as well as on a year-on-year basis. It came in only at around 330 crores. Though in the chemicals business, there was a bit of a recovery. It recovered by close to around 20% in terms of the EBITDA number. So the problem was on the fiber business. Now you look at the new business, which has the paint as well as the B2B e-commerce business. And out there, the revenues are moving up. So both on paints, we did see a revenue recovery. Even the B2B e-commerce business out there as well, the revenues did increase. The EBITDA loss on a sequential basis has come down a little bit, which is good news, actually. The net debt number has moved up because of the capex, that they're incurring both for their paints business as well as other businesses. But since the core numbers are weak, going with the tinge of red on Grasim.
Okay, all right. So Grasim, maybe a cautious start is what we're expecting. Let's move on and talk about a couple of consumer stocks. There is Patanjali as well as Bata. Manglam, how's the report card looking?
Well, for Patanjali, it's looking good. For Bata, not good this time, but things look better for them. So it's divergent. The reason why I say that is because if you look at Patanjali, the quarter was led by a sharp surge in edible oil prices. Now, most FMCG companies were speaking about how raw input prices or raw material prices were impacting their margins. Patanjali, on the other side, they sell some of these edible oils. So they got, the better end of the cycle. So their overall EBITDA actually increased by 57%. And net profit increased by 78%, and that was led by their edible oil business itself. The FMCG business actually underperformed, and that's largely because the consumer sentiment was weak, and also they saw margin compression to the tune of 350 basis points. The stock opens in the green because of good performance in the edible oil business, but from the highs, edible oil prices have come down as well. So whether it sustains those greens or not is the big question. On the other hand, for Bata, the revenue growth was subdued, 1.7% growth itself that came in, but margins were strong, 23% is what we saw versus 20%. The net profit was impacted by just a one-off VRS expense. The company said that they have seen significant volume growth after a long time, and they saw double-digit growth in hush puppies as well. So on the back of subdued revenue numbers, maybe the stock opens in the red, but I suspect it may see some green because of the commentary that came by and some of the internals.
Okay, all right, Manglam, we'll keep an eye out on both those two names. Well, I'm looking at Nalco, and these numbers were very, very good. Very strong set of numbers in quarter three. The only question is this the peaking out quarter, which could possibly be the case going by the pricing that we have seen on alumina? First, the numbers. Top line growth of close to around 40%, very good. Around 4 to 5% better than what some brokerages were estimating. The operating profit, brilliant numbers out there. 2,300 crores is what they've delivered, with the margins coming at close to around 50%. So no faulting those numbers. Last quarter was good. And the alumina business has been the big driver. So on a year-on-year basis, you had the profitability that was up by close to around 5 times. And on a sequential basis, it was close to have doubled. Even the aluminium business, well, you did have an improvement both on a year-on-year as well as on a sequential basis. The problem is the alumina prices that moved to around $750 per ton has come down to around $500 per ton. Besides the pricing, they've also got the benefit of some captive coal, because you see the cost of power consumed. That's come down as a percentage of sales to around 18% from around 25%. The company has also given a sweetener. They've declared close to around 4 rupees per share as dividend. It's very, very good set of numbers. The only question is it the peaking out quarter? And in fact, we'll have some answers from the Nalco management at 9:30 a.m. later today. So we'll keep an eye out. In his first ever interview, we'll have the CMD, Mr. Singh, who will be joining in. Let's get on to, other stocks. We have Manglam, who's joining in to tell us about Nykaa. Manglam, you're impressed with the numbers?
Bright pink, if I may, you're giving it a green color. The reason why I say that is because every time you think of consumer slowdown and then you look at Nykaa's numbers, for 2 or 3 quarters in a row, the company has reported top of the line numbers. Beauty business, GMV growing at 32%. When the company listed, the thesis was that beauty will lead the margin expansion and fashion will lead the growth because of higher total addressable market. But because of weak consumer sentiment and high competition, fashion growth has subdued, but beauty continues to actually accelerate. As a result of which, the overall revenue of the company has grown at 27%, the EBITDA has grown at 42%, and you're looking at net profit growth at 51%. This despite all the competition looking at the beauty business itself. And out there, the beauty revenue has grown by 27%, and EBIT margins have actually expanded by about 40 to 50 basis points. Yes, fashion is seeing relatively lesser growth, but upwards of 20%. Fashion itself isn't very bad. The company is investing still out there, so let's see how that goes. For starters, see some green on Nykaa.
Okay, all right. Mangalam, thanks very much for that. You'll hear from the Nykaa management at 9:50 this morning. So Falguni Nair, founder and CEO of Nykaa, talking about the business and the outlook. Well, Escorts Kubota is the next one we want to focus on. Sur is here with DL. So, good morning.
Morning, Prashant. So it was an all-round miss by Escorts Kubota for Q3 FY25, but more than earnings, what is going to be the problematic area is the guidance the company has given for FY25. By first look, guidance looking very weak. Talking about the numbers, revenue growth has come at 9% versus estimate of 35% growth, and margin has slipped below 12%. It has come at 11.4% versus expectation of 12.4%. Now, talking about the guidance, company has given guidance on first volume. It says transition to BS5 standards will lead to increase in construction equipment price, and that in resultant will impact the volume. Second, on margin, it says it will see a gradual improvement, but there is unlikely to be a major jump in the margin. Last is on the on profit. It says mostly FY25 profitability will be almost similar to FY24, so there is no major jump here also companies. Now, yesterday you had seen that M&M had talked about for industry tractor growth is likely to be in the range of 6 to 7% for FY25, and in resultant Q4 growth is likely to be more than 15%. So for industry, the growth is going to be healthy, but the question is how is it going to be turned out for Escorts Kubota? But on the basis of earnings, I'm going with red for Escorts.
Oh, okay. All right. So not looking that good for Escorts Kubota. Sudarshan got it. Let's talk about ESAF Small Finance Bank as well. Abhishek is here with the numbers. Abhishek?
Well, strong disbursements have not turned into AUM growth, which shows that, LTV might have been increased for customers of ESAF SFB. Disbursements are up 42.5% YOY and about 26.6% sequentially. AUM growth is very weak at just 5.5% YOY and a decline of 0.3% sequentially. The net interest income is down 18.5% YOY and about 10% sequentially. It's the only lender to see interest income decline both YOY and quarter on quarter. Net interest margin, hence, as a resultant, has declined both YOY and quarter on quarter to 7.9%. Provisions have shot up by 197% YOY and about 20.5% sequentially. They are the only lenders to report a net loss for second consecutive quarter. They have reported a net loss of close to 211 crore versus 190 crore in the previous quarter. Now, slippages have been elevated for them. Annualized slippage ratio is at 10.5% versus 10.8% in the previous quarter. The write-offs are high, which means that the asset quality has largely remained stable for them. Back to you.
Okay, all right, got it. Abhishek, thanks for that. Let's quickly recap our list of top stocks to watch. The ones that have positive news flow around them are Apollo Hospitals, Patanjali Foods, Nalco and Nykaa. The stocks that have negative news flow around them, Hindalco, Eicher Motors, Grasim, Bata, Escorts Kubota and ESAF Small Finance Bank. So plenty of ones with the bit of a red color around them this morning. Let's also talk commodities. We have Manisha Gupta joining in with the latest. Manisha, never a dull moment with all the tariff talks and the US headlines. But what are you watching out for? By the way, you alerted us earlier. There was this sudden volatility in gold after it surged to all-time highs. But you tell us, what's the latest?
Well, absolutely. So if you look at the gold prices, especially the charts today in Asian markets are nothing short of a surprise. It's a very, very big jump that we've seen into the prices. There's almost $30 to $35 of a gain. So Asian markets, when you see that kind of a gain, tells you that Chinese are buying in some sense, and that's exactly what really seems to be happening. So we started yesterday morning was 28.50 of a high, and currently we're trading at 29.40. So it's been $100 of a jump up that we've seen in the last 24 hours coming in. Absolutely, a lot of safe haven buying, easing monetary policies, the global tariffs, especially from the US on aluminum and steel, tell you that the inflation will continue. And of course, the point that the longer this tariff conflicts or trade conflicts continue, it would hurt a lot of other asset classes, but the gold prices continue to shine bright here. Markets also have seen China add more gold for the third straight month in terms of central buying there. Street will watch out for the Powell testimony today as well. But yes, gold is the place to watch out for. $100 of a jump up, huge amount of Asian buying, China buying for its insurance companies as well, with an expectation that $3,000 announced perhaps is a possibility in the month of February itself.
Okay, all right. Traditional rush for safe haven buying, and it's indeed proving to be exactly that. Manisha, thank you very much for the details over there. We do have to take a very quick break at this point in time. We'll come back on the other side. We'll have, of course, the fundamental conversation going. Gurmeet Chadha will join in with some stock ideas. And then, of course, we move on to technicals in a bit.